Welcome to my books and storytime by mybookssummary.com. The Intelligent Investor, a timeless guide to smart investing. Introduction. Imagine you're standing in the middle of Wall Street, surrounded by flashing screens, fast-talking traders, and an overwhelming sense of chaos. The stock market, with all its unpredictability, can feel like a casino to many. But Benjamin Graham, the father of value investing, saw it differently. To him, investing wasn't about gambling, it was about patience, discipline, and rational thinking. Published in 1949, The Intelligent Investor is one of the most influential books on investing ever written. It continues to shape the way serious investors approach the stock market. Warren Buffett, one of the greatest investors of all time, has called it by far the best book on investing ever written. At its core, the book teaches that successful investing is not about taking wild risks but about making informed, logical decisions. It stresses the importance of value investing, buying stocks when they are undervalued and holding them for the long term. Graham provides timeless principles to help investors navigate market fluctuations and avoid common pitfalls. This summary will explore the key lessons of the Intelligent Investor in detail. We will break down Graham's major concepts, understand the difference between investing and speculation, and see how we can apply his wisdom in today's financial world. Chapter 1. Investment versus Speculation. Know the difference. Graham begins the book by drawing a clear line between investing and speculation. He defines an investor as someone who makes informed decisions based on thorough analysis and expects to achieve a reasonable return over time. Speculators, on the other hand, try to predict short-term market movements and often act on gut feelings rather than logic. A true investor sees stocks as part ownership in a business. They analyze a company's financial health, earnings, and future potential before buying shares. Speculators, on the other hand, treat stocks like lottery tickets, hoping to get lucky with short-term price swings. Why is this distinction important? Because speculation is risky. The market is driven by emotions, fear, greed, and excitement, which often leads speculators to make irrational decisions. Graham warns against falling into this trap and urges readers to focus on long-term, data-driven investing. Chapter 2. Mr. Market, Your Moody Business Partner. One of Graham's most famous concepts is the allegory of Mr. Market. Imagine you own a business and every day your business partner, Mr. Market, offers to buy or sell shares at a different price. Some days, Mr. Market is optimistic and offers a sky-high price. Other days, he is pessimistic and offers a bargain. The key lesson? You don't have to accept his offers. Instead, you can take advantage of his mood swings, buy when he's pessimistic, prices are low, and sell when he's overly optimistic, prices are high. The stock market behaves just like Mr. Market, fluctuating wildly based on emotions rather than logic. An intelligent investor stays calm and takes advantage of these fluctuations instead of being controlled by them. Chapter 3. The Margin of Safety, Your Financial Armor. One of Graham's core principles is the margin of safety. This means buying stocks at a price significantly below their intrinsic value. Doing so protects you from mistakes in judgment and unexpected market downturns. Think of it like driving over a bridge that can support 20,000 pounds. If your truck weighs 10,000 pounds, you have a strong margin of safety. But if your truck weighs 19,500 pounds, you're taking a huge risk. By purchasing stocks at a discount, you give yourself a cushion against unforeseen market events. Even if your valuation is slightly off or the market takes a temporary dip, you are less likely to suffer major losses. Chapter 4. Defensive versus Enterprising Investors. Graham divides investors into two categories. The defensive investor, this investor prefers a low-risk, hands-off approach. They focus on strong, well-established companies and bonds, aiming for steady, reliable returns without much effort. The enterprising investor, this investor is willing to do deep research, actively seek undervalued stocks, and take calculated risks for potentially higher returns. Which type should you be? Graham suggests that if you don't have the time, patience, or expertise to analyze stocks thoroughly, you should be a defensive investor. Many people try to be enterprising investors without the necessary discipline, leading to losses. Chapter 5. Stocks versus Bonds, Balancing Your Portfolio. Graham advises keeping a balanced portfolio to protect against market volatility. He recommends a minimum of 25% in bonds for stability, a maximum of 75% in stocks for growth potential. The key is to adjust your allocation based on market conditions. When stock prices are high, increase your bond holdings. When stocks are cheap, increase your stock holdings. This countercyclical strategy helps you buy low and sell high. Chapter 6. The Perils of Market Predictions. Graham warns against trying to predict the market. Many investors fall into the trap of timing the market, but even the smartest analysts often get it wrong. Instead of trying to guess what will happen next, Graham recommends focusing on company fundamentals, earnings, assets, and long-term growth potential. Making investment decisions based on sound analysis rather than speculation reduces risk and increases long-term gains. Chapter 7. Value Investing, Finding Bargains in the Market. At the heart of Graham's philosophy is value investing, buying stocks that are trading below their intrinsic value. He suggests looking for companies that have low price-to-earnings (P/E) ratios, strong earnings history, low debt levels, consistent dividend payments. By focusing on undervalued stocks, you minimize risk and maximize potential returns. Final thoughts. Why Graham's lessons still matter. Even though The Intelligent Investor was written decades ago, its principles remain as relevant today as ever. Markets will always be driven by emotions, but intelligent investors stay disciplined, patient, and focused on fundamentals. Investing isn't about luck, it's about strategy. Graham teaches us that if we approach investing with rationality and patience, we can build wealth steadily over time without falling victim to market hysteria. Recommendations for further reading. If you enjoyed The Intelligent Investor, here are other great books to deepen your knowledge. Common Stocks and Uncommon Profits by Philip Fisher, a look at qualitative investing strategies. The Warren Buffett Way by Robert G. Hagstrom examines how Buffett applied Graham's teachings. Security Analysis by Benjamin Graham and David Dodd, a technical deep dive into valuation. The Intelligent Investor isn't just a book, it's a lifelong guide. Whether you're new to investing or a seasoned pro, revisiting Graham's wisdom can help you navigate the market with confidence, discipline, and long-term success. Stay tuned for more enlightening content. Head over to www.mybooksummary.com. Don't forget to subscribe and share the magic with friends. And let's grow together through the power of books and interesting stories.